I think we're still waiting for a couple of people. Are we ready? Okay. So I think if everybody has been logged in, wait a second. Okay, so welcome back to our second webinar on financial literacy. Last session, we covered income taxes, budgeting, saving, and shopping, and scams. This session will be recorded for later use. So let me welcome our first speaker, and his name, it's Henry Camo. He is the Senior Financial Assistant for the Durham Community Legal Clinic, and he will be talking on banking and financial services. Henry?
While we're waiting for Henry, also note that this meeting is being recorded.
I hope everybody can hear me. Can you?
Yes.
All right. So I'll be talking about banking and financial services this morning, and I'm sharing my screen with the slide. So to start with, banks and credit unions are the most safe places to deposit and track and keep track of your money. Having an account in a financial institution is essential because it helps to build a solid base for good money management and enables you to create a saving plan that grows. So there are some reasons to choose a particular bank or a credit union. You need to consider these factors, not in any particular order, whatever is most important for you. So convenience, some people would like a bank that is very close to maybe where they live or where they work. You need to consider how many ATMs or bank machines they have around the area that you live. You also need to consider the services, the cost of services, because having a bank account will definitely cost you some money, which will be in form of monthly service fees. And you also need to consider how much interest will be offered on your deposits. So it is best to do research by finding about the account packages and services the financial institutions offer and compare so that you make sure that you get the services you need at the lowest price. So there's a tool that is available to compare these financial institutions. Luckily, it's a tool by the government institution. This is the link down here, and I'll quickly show you how it works. So this is the Government of Canada account comparison tool. It's from the Financial Consumer Agency of Canada. So you can narrow your search on this particular tool. For instance, you just fill in the province you live, the kind of account that you need, usually a checking account, which currency by default is Canadian dollars. You choose who you are. You probably be a senior or a GIS recipient, youth student, or a newcomer, whatever is your situation right now. And then you can pick here what is your monthly fee that you're ready to pay. If it's zero, if you don't know, you can just keep it, you don't know. And you can fill up all the other options there, including if you're looking for a specific bank or a credit union, you can choose up to 10 institutions here. Okay, and then you click search. So the tool will give you the results. For instance, here in the few options that I had put in there, it shows you like Tangerine will give you a zero monthly fee. unlimited combined transactions, and the account will be in Canadian dollar. Okay, there are a few options there. This is the 4 or 5 banks which I chose. So remember, you can choose up to 10, and they give you all the options that are available to you from those banks. So you can keep checking, or so that you make sure you go through all the banks available on the drop-down menu, and then you can pick whichever fits your situation or fits your current financial situation best. So going back to the slide, I'll talk about how to open a bank account. So in Canada, everyone has the right to open a basic savings account as long as you have an ID or the bank will accept, usually a photo ID or 2. Then if you're not suspected of or convicted of a fraud, then you can open a bank account. So when you go to the financial institution where you want to open a bank account, so make sure you have the right ID with you. Then you prepare a list of your banking needs and come with a set of questions to ask the bank staff. And if you refuse an account, ask the bank to put it in writing, and then you can make a complaint to the bank ombudsman office or the Financial Consumer Agency of Canada. So just going back a little bit. So this website here will take you to the ombudsman office where you can make complaints in case you have any issues with the financial institution. And I'm going to show you how the website looks like. So this is the website for the Ombudsman office. And you can see on my left here, there's a link which you can follow to make a complaint. So you just click in there, you fill in the details that you have regarding the complaint. They are all self-explanatory questions. If you have any documentary evidence, make sure you have taken maybe a picture of it, and then you can upload it to the website. And then they are giving you a timeline there that you have maybe 90 days to deal with your complaint. And if you need, there's any additional information, the Ombudsman office recommends you don't create a new complaint. You just give them a call on this number or email them on this email address, and then you can update your complaint. All right, going back to the slides. So I'll talk about alternative or fringe financial services. So these are services which are outside of the traditional or regulated banking system. And these services are often used by people who need fast access to cash or credit. So they include, among others, cash checking outlets, payday loan companies, rapid refund tax services, pawn shops, rent to own or rent to lease programs. So you need to remember that these services result in a much higher fee being paid for the service than the equivalent mainstream or community services. And these alternative or fringe financial services can be a very expensive way to borrow. So if you make a decision to go through that route, remember, you'll be paying a much higher fee. It will cost you a bit more than going through a traditional bank. So these alternative or fringe financial services, I'll be comparing them to the mainstream banking financial services. So in the mainstream banking services, so your money is secure and protected. They are very strictly regulated. They have a number of free services. Usually they have lower service fees. They charge a lower interest on charges on loans, and you're able to save your money and earn a bit of interest. They also give us other services like checks. You can do direct deposit, even from your phone. You can scan a check and deposit it. You can do automatic bill payments so that you don't have to go to the bank and to make these kind of transactions, usually utility bills and phone bills and so on. You can do online or telephone banking, and they also give you an ATM or a debit card, which you can use to make payments as well. However, the alternative financial services, they have their own advantages as well. They give no holds on paychecks you can access your money anywhere you need. And you might notice in your neighborhood, they are almost in every corner. They have very flexible opening and closing hours. Some open late in the night at 8 o'clock. You're able to get credit despite having a bad history. Some of them don't even require to check your credit. So you just walk in and they accept you even if you have a bad history. But remember, these are more expensive services than the mainstream services. I think that is it for me. If you need to learn a little bit more about the fringe services, I recommend you go to the website from Prosper Canada. Here, and all the services you can see them in this PDF document here. I probably can put it in the chat for everybody to see it. There we go. So you can read more about the fringe financial services. There's a lot of information on the website there. And they can also, the website is explaining, for instance, how much you'll be paying if you take a $1,000 on the from the check cashing outlet. So I'll be handing over the meeting to Lisa, unless there's a question.
Any questions? Okay, as to the next topic, we're going to have Lavinia Inbar. She is our staff lawyer at the Durham Community Legal Clinic, and she will be talking about credit basics.
Hi. So credit basics. So credit is a system of getting something now, but paying for it later. It is a promise to pay. But the convenience of delaying payment usually comes at a cost, and sometimes it's a steep cost. The slide talks about 3 different kinds of credit. Revolving credit. You can use or withdraw funds up to a pre-approved credit limit. The amount of credit available decreases as the funds are borrowed and increases as they're repaid. And this credit may be used repeatedly. You make regular payments based on the balance of your account, and you may repay over time, subject to any minimum payment requirement, or you can pay in full at any time. So an example of this, the most obvious example, is credit cards. That's the most common example for most of us. The next one on the slide, installment. That's credit that has a fixed number of payments, making payments by installments. You borrow a set amount of money and agree to pay it back over a fixed period of time until the loan is paid off. The payment is the same every month, and the payment includes the amount you borrowed plus the interest. So for example, a car loan, a mortgage, a student loan, personal loans. The other kind is what's called open credit, and this is payment based on usage, and therefore it's not the same each month. Payment is usually due in full at the end of each billing cycle. The customer satisfies the contract conditions when they pay the bill in full each month. If they do not pay in full, interest will be charged, and one's credit report can be affected, and we'll talk about that later. And this cycle can go on as long as the consumer has an account with the service provider. So an example is your utility company account, when you pay your utilities. These are all forms of credit. So next slide. So the next slide shows that the good side and the bad side of credit. So credit is not necessarily a bad thing. It can be convenient and safer in many ways than carrying and paying with cash. And big credit, like for loans for those really big ticket items like cars, homes, business tools and assets and education, are tremendously useful for building our prosperity, our future. But there is a negative side. For one thing, They can make it too easy to overspend and get into trouble. And even if you don't get into the kind of financial trouble that results in collection agencies coming after you or having to declare bankruptcy, you can end up on the hook for much more money than you bargained for. So next slide. When you use credit, say a credit card or take out a loan with the bank, you have to pay back two things. The money you borrowed, I should check the slide, but yeah, the money you borrowed plus interest. And interest is what kills you. Interest is slippery. It sneaks up on you. It is why people get in trouble with credit. And I'm going to focus on credit cards because credit cards are the most popular form of credit in Canada. So get myself organized here. I mean, most of us use them regularly. I know I do. So look at the, is there another slide? Yeah. Sorry, I'm disorganized with my slides, but so there's this, see if the right chart is up. Okay, so this chart illustrates how interest can sneak up on you and bite you in the behind. So in a nutshell, what this chart shows is that if you pay up front for something, say with cash or your debit card, the cost of what you buy is the cost of what you buy. It's the cost. But if you use credit, you will pay much more, sometimes shockingly more. And you will be shouldering the debt for a very long time. If you look at the credit card example, you can see that for a credit card, which you use to spend $1,000, if you make just the minimum monthly payments, you will end up paying well over double, $2,397.26. And you'll be carrying that debt for over 10 years. So how does this happen? You pay all this money, but the debt barely goes down. And it's because when you pay the minimum monthly payment, you are hardly paying anything towards the debt. Most of that minimum payment, and I mean most of it, goes to the interest alone. Right? So if you owe $1,000, and for the sake of easy math, let's say the interest rate on your credit card is 20%. I cannot do complicated math. You owe $1,000, interest on your card is 20%. And it probably is very close to that. It's probably 19.5%, so close enough. So the calculation for the minimum payment is the credit card balance, your $1,000, times your annual interest rate, that 20%, so 0.20, divided by the number of payments a year, 12 monthly payments over a year. Okay, there's your little formula. So when you work that out, which I didn't do in my head, I worked it out ahead of time, but you do that, 12 $1,000 times 0.20 divided by 12, you get 1667 interest per month. So your interest on that $1,000, if you're making minimum payments, your first interest payment, 1667 a month. So the monthly interest used by credit cards is usually between 2 and 3%, right? When they do the monthly workout of the interest. So let's say 2%, which means that the minimum payment on that credit card will ask you for will be $20. So you owe $1,000, you get your credit card statement because you spent $1,000, it'll say your minimum payment is $20. Okay, so you make that $20 minimum payment. Has your debt gone down by $20 to $980? No, your debt has actually only gone down by about $3. to $996.67. You're only paying $3.33 towards the balance. The other almost $17 is just interest, just gone. Okay, so that probably hurt everybody's little brain a little bit, and I'd like to apologize for that. So to make up for it, I'm going to ask Catherine to put on a little video now before I hurt your brain again, because I will. So Catherine, can you please play that little video? Oh, no sound. Could we get sound on that?
Is there no sound on it?
No.
Okay, sorry, 1 second.
Welcome back to Get It on Credit. If you're just joining us, we've given our contestants the exact same credit card contract to sign, the exact same credit card with a 9% introductory interest rate, and they all bought the exact same MP3 player that cost $284. Now, it's time to see just how much those MP3 players ended up costing all of you. Yes, Greg.
But didn't you say we bought the same MP3 player and that they all cost $284?
I sure did, Greg. But even though you bought them on the same credit card with the same introductory interest rate, you all did different things when it came time to pay the credit card company. Let's see what that means. Now, Angela, you wisely chose to pay off the balance of the credit card right away.
Yes, my Uncle Frank always told me neither a lender or a borrower be. That was one of the last things he told me before he was hit by a bus.
That's completely depressing. But Angela, what that means is that your MP3 player ended up costing you $284. Yes, Greg.
But my MP3 player also cost $284. I have the receipt for it right here.
Yes, Greg, you are correct. At the time of purchase, that MP3 player cost you $284. But you chose to pay the credit card company back by paying only the monthly minimum payments.
So what's wrong with that?
Well, Greg, there's nothing wrong with that. But because you were paying 9% on $284, you were making a payment of $7.07 a month. By the time you finish paying for the $284 MP3 player, not only will it be obsolete, but it's going to cost you $339.36. Oh, that's what I thought you'd say. Now, Stephanie, let's look at what you did with your credit card. Stephanie?
Oh, sorry. Did you say something, Frank?
No, but frankly, I know what I'd like to say. Stephanie, how much do you think your MP3 player ended up costing you?
Hello. We all paid the same price for our MP3 players, $284.
Oh, that answer is wrong, and it's going to cost you big time, I'm afraid. Because you see, Stephanie, buried in the fine print of that contract you signed was a clause that said that by missing a monthly payment, you have violated the contract.
Oh my gosh, it does say that.
And when you violate the conditions and terms of the contract,
They reserve the right to increase the interest rate.
that's correct, Greg. And Stephanie, because you missed more than one payment, the credit card company raised your interest rate to a whopping 26.5%. Which means that by the time you finish paying that $284 MP3 player off, making monthly minimum payments at 26.5% annual interest rate, it's going to cost you $480, almost double the original amount.
Oh my gosh, that's horrible.
Once again, that's correct, Greg. That is horrible, but true. Not to mention how badly missing payments affects your credit score and your future borrowing costs. Well, that's all the time we have today for Get It on Credit. tune in next week when you'll hear Greg say,
Oh my gosh!
until then, pay down those credit cards. I'm the funny money man, and I think you should know this.
Well, I like that little video. And, you know, I think it makes the point better than I can. But that video, it only talks about a 9% interest and on a very small debt. And interest rates on credit cards these days are more like 19.5% on most credit cards, most people's credit cards. And credit card debts are often a lot bigger than what was shown in the video. So now I'd like to show you a calculation tool. And the link for it is actually on the previous slide at the bottom. It's the last one that compares different payment options to pay off credit card balances. So Catherine, can you please put up that tool? It's called the Credit Card Payment Calculator, and it's from the Financial Consumer Agency of Canada. So this is it's one of those free tools. It's useful if you like computer stuff like this. Okay, so let's work through this together. Let's see, what can I do on the screen? So I won't make you actually work through the tool because your eyes may glaze over. But there's the tool, and I'll work through something with you together. I don't know if we can work through it. If I can myself manipulate this tool, I guess.
You can click on the things that you want, Lavinia.
Okay. So I like this tool because it exposes just how sneaky interest is. We all kind of vaguely know that interest on a credit card purchases will add some costs, but most of us certainly don't realize how much that cost grows over time. So I'm going to see if I'm able to, maybe if I make the screen bigger through this. So okay, so you name your search, like what province you're in, Ontario, what currency, Canadian, are you banking with a credit card for, it's my problem is I can't see the screen. Low purchase interest rate, okay. All right, so next. Sorry, I don't recognize this part of the tool. Let's yeah, I'm taking up too much of your time. I won't work you through the tool. You can look at it at your leisure. But what it does is you can put in a real amount, and and real amounts nowadays are more like 4,500, and it does the math for you, and it works it out. And if you're paying just the minimum payment at 4,500, and I worked this out at home, you know, it ends up costing you something like 21 years to pay it off, and you end up paying well over $10,000 on that 4,500 if you're just making the minimum payments. If you're making minimum payments and just an extra few dollars every month, let's say you just add $5 to your minimum payment every month. So your minimum payment of $4,500 would be about $150. If you just make that $150 minimum payment, it's going to take you over 21 years to pay it off. It's going to cost you well over $10,000. If you add just $5 a month to that 150, you're going to pay several thousand less, and you're going to pay it off in, I think, something like 7 years. And the best thing to do, other than paying it off, I mean, if you can pay it off when it comes due, then you just pay $4,500. But if you can't do that, set it up so that you're making a fixed payment amount every month. Let's say $200. Okay, so $200 a month, automatically set up your internet banking automatically to $200 a month to pay off this debt. And it'll pay that debt down in something like 3 years. And I forget how much interest, but a lot less interest. But the message is minimum payments will kill you, and it'll take you forever, I mean, literally decades, to pay down this debt, which is not that huge. $4,500 is a lot of money, but it's not that much money. But it will be in 21 years when you've paid it down and it's over $10,000. And keep in mind, all this is if you don't use that credit card again. If the only thing on that credit card is that $4,500. So if you use your credit card again, you buy something, and even if you're not buying much, you're being responsible, you're still adding to that $4,500, and that debt's not going to go down. So, I mean, the message is interest is sneaky. It will sneak up on you, and it'll knock you flat. So they say time is money. In this context, the more time you take to pay off the debt, the bigger the debt gets. So you can pay off the credit. If you can pay off the credit card balance in its entirety as soon as it comes due, that's great. You just pay what you paid for. You paid the $4,500. It's gone. Then you won't pay any interest. But if you can't do that, try really hard to pay more than the monthly minimum, as much as you possibly can. Thanks. That's all I have to say about credit basics. So any questions? Okay.
No questions. I think Lavinia, you're going to speak on credit reporting.
Yep.
The same.
Yeah. So yeah, there's the slide. Okay. Yeah. Credit reporting kind of naturally follows from credit basics. So first slide, credit reports are produced by the credit bureaus. So what are credit bureaus? So credit bureaus are agencies that collect information about how we use credit, and they produce these personal credit reports. So credit bureaus are actually private companies. They're regulated by the province, but they are not part of government. They're for-profit companies. There are two credit bureaus in Canada, Equifax and TransUnion. They can collect information about your credit use from credit card companies, financial institutions, other lenders. So what do they do with this information? Credit bureaus then provide this information for a fee, they're a for-profit company, to lenders who want to know about your credit history or your ability to repay debt. Lenders use this information they get from the credit bureaus to predict how you will manage credit in the future. In other words, to decide whether or not to lend you money. So who exactly can access your credit reports? Well, among the lenders, Lenders are the big category. So financial institutions, credit card companies are the big ones. And they will ask your permission to check your reports. And this is to check your credit worthiness. They can use the information in your report to decide whether to give you credit, whether to give you a credit card, and what your credit limit will be on the credit card, or if it's a loan you're asking for, how much they're willing to lend you, and what the interest rate will be for you. Someone else who can access your credit reports are landlords. So if you're trying to rent an apartment, some landlords may ask you to give them access to your credit report when you fill out a rental application. They use this information to see if you are likely to pay your rent. So we here at the legal clinic, Durham Community Legal Clinic, we often get calls from people saying, hey, I'm applying to rent this apartment and the landlord wants to do a credit check. Can they do that? Yes, they can. Insurance, some insurance companies use credit information along with other information when deciding to give you insurance and what rate to charge you. Employers, some employers may ask to do a credit check when you apply for a new job. They may use your credit report to help them decide whether you will be a responsible employee. So for example, government departments or companies that deal with credit or investments will often ask for a credit check for new employees or contractors. And this is part of their security screening. Okay, so next slide, please. So what are your rights around your credit report? So you're entitled to get a copy of your credit report for free once a year if you ask for it by mail or in person, or anytime online for a fee. No one is allowed to see your credit reports without your permission. A credit bureau can only provide a copy of your reports to someone for certain purposes, applying for credit, collecting a debt, applying to rent an apartment, applying for a job, applying for insurance. Credit reports are not shared across international borders. Your credit history does not follow you to a new country. And, I've known of people who have left Canada because they have bad credit, dodgy creditors, and they leave. It's a strategy. So why should I have a copy of my credit reports? Equifax or TransUnion do not share information with each other. And lenders who report about you to a credit bureau might only report to one of them. So each credit bureau may have different information about you. And this is why it's a good idea to request a copy of your credit reports from both of them, because mistakes happen. And it's up to you to check your reports and to take steps to correct the information on your report, the information about you. So let's say you ordered your credit report and you're now trying to understand it. They're really hard to understand, and they use a lot of abbreviations. I'm not going to put one on the screen because they're hard to see, hard to read, and but I strongly recommend you have a look at yours. The report will have your personal information like your name, etc. Then there'll be a section listing any people or companies who have made inquiries about you, have asked to see your credit report. And having too many inquiries can have a bad effect on your credit score. But your own request to see your own credit report will not affect your credit score. So you can check it. It's not going to affect your credit score. And and then the next section, it will be account information. This is the important part. This is your credit history section. It contains information about all of your credit accounts, including your loans, your credit cards, your department store cards, your lines of credit, your consumer loans. And this account information usually includes the creditor, the account number, the balance owed, the credit limit, and your rating on the account. So the rating on your account, all account ratings contain a number and a letter. The letter is an R, I, or an O. And that refers to the type of credit you have. R stands for revolving credit. Remember, that's the kind of credit you're given a credit limit up to which you can spend, and when you make a payment, the credit is ready to use again, so it revolves. So like credit cards, overdraft protection, lines of credit. Okay, that's R. I is for installment credit. Like we said, paying in installments. It's the kind of credit where you get some money all at once and you pay it back in regular installments until the balance is zero, like a car loan, student loan, or mortgage. And O stands for open credit. That's the kind of credit where you get a bill in the mail monthly, like your utility bill, and you're expected to pay it in full. And these often do not report on a regular basis to the credit bureaus. Besides that letter, each credit also gets a number red rating on a scale between 0 and 9. So R1 means it's your revolving credit. R1, number 1, it means you pay your bills on time according to the terms of your credit agreement. So that's really good. R9, not good. R9 means you have not paid your bills as agreed and the account has been placed for collections. So that's bad. And, there are in between numbers and so on, but R1 is really good all the way to R9, which is the worst. R8 is repossession, for example. Okay, so these ratings, these R and the number ratings, R1, I1, I9. These ratings affect how people will view your credit report and your credit worthiness. So you got to make sure that all the information in this section is correct. Banking information, that's the next section on your credit report. And this section on an Equifax report anyway, it's part of the account information credit history section. It's all still in that section. And it specifically contains information about any bank accounts you have. And it will also include whether you have any NSF checks, not sufficient funds, bounced checks on your account. There's a section then on public information. And this is any information about accounts that have gone to collections. And it will say if you've ever been bankrupt. It also lists judgments made against you when a creditor has taken you to court. And then there's a last section, which is consumer statement. And this is where you can add a statement to explain any of the information on your report. So for instance, if you received a poor rating on one of your accounts, but there's an explanation, you could explain, for example, you were unemployed for a time or that you suffered a setback due to illness or something. So you can put that information in the consumer statement, explain yourself. So how long does all this information stay on your credit report? The rules vary from province to province, but generally 6 years. Only 3 years for consumer proposals or credit counseling, but most other things 6 years. So bankruptcy, collections, credit transactions, judgments, they'll all sit there for 6 years. So what if you find an error? This is why you're looking at your credit report. What if you find an error? Find the documents that prove there is an error. For example, if the report says you did not pay a bill, find the receipt that shows you made the payment. Make a copy for your proof. Call the credit bureau. Explain the error. Find out what they need from you so they can do a check on the item in dispute. You can send the credit bureau a letter or fill out their dispute form from their website and include all the information needed to check into and correct the error. So be aware that they're not going to be quick about this. The process can take up to 30 days. So you got to wait. But the credit bureau will contact the creditor or financial institute to confirm that an error was made. And if they agree that an error was made, they say, yeah, you're right, an error was made. The credit bureau has 30 days to correct the error on your report. It's actually 90 days in Alberta. If the financial institution does not think there was an error, so they say, no, we disagree with you. We think whoever reported this about you, they're right, you're wrong. You can still write a statement explaining your side of the story, and the credit bureau will add this to your report. You can also contact the particular financial institution to register a complaint. And by law, all financial institutions in Canada must have a process for resolving complaints from customers. So you have recourse to that. Okay, let's look at slide 3, credit score. Okay. So credit score is a magic number people talk about, but this is not on your credit report. This is a complex subject. The real credit score is sometimes called a FICO, F-I-C-O, or beacon score. And it is a number ranging from 300 to 900. It is a way of summing up all of the information in your credit report, and it's used to measure risk, the risk that you might not repay your credit as agreed. And credit models vary. There are different credit models and they vary, but generally a credit score from 660 to 724 is considered a good score. 725 to 759 is considered very good, and 760 and up is considered an excellent score. Higher credit scores mean you have demonstrated responsible credit behavior in the past, which may make potential lenders and creditors more confident about your ability to repay a debt when they evaluate your request for credit, evaluate your application. And lenders generally see those with lower credit scores as a bad risk. Those with credit scores between 660 and up, they're acceptable or lower risk borrowers, but below 660 may be less qualified to qualify, less likely to qualify for better loans. And those with scores that fall into the poor credit range, so generally below 560, are more likely to have great difficulty in getting credit or qualifying for better loan terms. So credit bureaus use a mathematical formula to get these credit scores. And if you want to know the scores, you will have to pay for the analysis through one of the credit bureau websites. But it's a big but, so to speak. The credit score you get from the credit reporting agencies may not look like your FICO score. The credit reporting agencies will give you their own score, not the FICO score. If you request your score from Equifax, the fine print will tell you that you are not getting the FICO score, you're getting their score, Equifax's score. Same with TransUnion. And if you request your score from Equifax and from TransUnion, you will probably get two different scores. However, when you go to a bank, say for a loan, you go somewhere and ask for credit, like a loan, the lender, the institution, will probably not use either of those scores. And they will tend to use the FICO score. The credit agencies buy the FICO service from the US, but they won't share that information with you. So the only way to get your real score, your FICO score, is to get a business to run a credit check on you. And when the business gets the FICO score, to share it with you. But having a credit check like that done can affect your credit ratings. Remember I said that it shows on your credit report how many inquiries that there have been. Too many inquiries will hurt your credit rating. So unlike in Canada, in the US, Americans can access their score easily by purchasing it on FICO's website or through FICO's open access program. And so no risk to it impacting their credit rating, but we can't. So the only way you're gonna know your FICO score if you ask a business to run a credit check on you. FICO scores are really old. They were established in 1989. They're called FICO because it was the Fair Isaac and Company that standardized credit scores. Anyway, that's just history. But all credit bureaus and the FICO score too, they use a mathematical formula based on many factors to arrive at your credit score. And each credit bureau have their own proprietary algorithms, so that's why their results vary, and we don't know what the algorithm is. It's proprietary. They're not going to tell us. But generally, there are 5 main factors used to arrive at your credit score, and they don't all have equal weight. Some count for more than others. So the biggest factor that has the most weight is your payment history. So that weighs more heavily in the mathematical formula, carries the most weight. So lenders are most concerned with your past borrowing and whether you repaid your debts on time. So paying bills late or having unpaid accounts sent to collections will lower your score. The amounts owed is another pretty big chunk that goes into the mathematical formula. It has quite a bit of weight. And this factor compares the amount of debt you have to the amount of debt available to you. So the closer you are to your credit limit, right, that will affect your score. The length of your credit history, that's a small percentage, around 15%. This factor looks at how long you've been using credit. So it can help your credit score if you've been keeping accounts open that you've had for a long time. But if you're very young and you have no credit history yet, you will have a poor credit score, not because you're a bad risk, but because you just haven't used credit yet. You're just starting to build your credit history. And the types of credit you've had, that weighs usually about 10%. So having different kinds of credit can improve your score. They can show how you manage different forms of credit. So credit cards, lines of credit, car loans, student loans. And other factors that affect your score are if you've had accounts turned over to collections. That's going to hurt you. Will lower your score a lot. Or if you filed for bankruptcy, that will lower your score a lot. But factors that do not affect your score are inquiries that you make into your own credit report. That's safe, you can do that. And mortgage information may appear on your credit report, but it's not used to calculate your credit score. So how do you improve your credit score? Well, the big one is pay your bills on time. Try to pay your bills on time. If you can't pay your bills on time, take action. Don't ignore it or give up on it. Get in touch with the creditor. Try to work something out. I was talking about credit cards before. Try to pay your credit card balances in full. That will help a lot. And that's a major form of credit most of us carry is credit cards. Pay your debt as fast as you can. I mean, not all of us can pay off our whole debt immediately. Hardly anybody can do that. But pay it off as quickly as you can. And really only take on the amount of debt that you can manage. So stay within your credit limits. Do not go over the credit limit on your credit cards. Do not apply for credit cards too often. And it can be good to show, how to handle different kinds of credit. I said before, but every time you apply, it results in an inquiry to the credit bureau. So you don't want too many of those hits, too many inquiries. But do use credit. So the advice here is not, don't just never use credit. Do use credit. Like I said, if you're young, you've never used credit, you won't have a credit history, you won't have a credit rating, and nobody will lend you anything because you have no history to check. So do use credit, but build a good credit history and correct errors. That's the whole point of what I've been saying. You check your credit report to correct the errors. Okay, so that was just a relatively quick overview of credit reporting. Any questions?
Okay. Anyone have any other questions for Lavinia before moving forward? I see Elliot Kelly has put a comment in the chat. Many banks reveal one credit score for free. That's really good to know.
Thank you, Elliot.
Yes. And so if there are no other questions in the chat, we will go on to Catherine O'Connor, who is a law student at Osgood. And she's going to be talking about debt and debt management.
Hi, everyone. So kind of relating to what Lavinia's been talking about is debt. And I know that this is a topic that can be very stressful. Thinking about our own personal debt can cause us a lot of worry. And a lot of us would probably prefer not to think about it, but a lot of the time that's how it can end up spiraling out of control. And it's important to know that debt is a financial tool. So like any tool, what matters is how you use it, when you use it, and why you use it. It's not bad in itself. I think most people have debt, and probably most people are worried about it as well. And there can be a lot of benefits to borrowing money that Lavinia was talking about as well. But there are some real costs to think about, and it's important just to know kind of what you're getting yourself into. So on this slide, you can see 3 different types of debt that we've categorized here. So if you look at good debt, it's something such as buying a house or getting an education, kind of something that's investing in the future, maybe something that's going to allow you to increase your chance of growing your wealth or earning more money in the future. And then if you look to bad debt, it's used for items that are wants, not needs, which is something we talked about in last session a bit, things that we can live without versus things that we can't. And it could be used for paying for things that we haven't actually saved up for yet, and that don't hold their value over time, like something like a house that would hold value versus something else that maybe doesn't. And the debt itself there may actually last longer than the item that we bought, which Livany was talking about there as well with interest payments, that sometimes the debt itself can last extremely long because we're just paying the interest part there and not actually paying down the actual amount that we borrowed. So then lastly, looking to ugly debt, that's something that has very high costs. And that could be something that has very high financial costs or even emotional costs. So an example of that could be something like a payday loan or a pawn shop loan on an item that you really treasured that you had to sell, or it might be a loan from a family member or a friend, and that could damage your relationship relating to the emotional costs there. But we are sometimes forced to take on some bad or some ugly debt to live or just to deal with an emergency, but it's just important to know some of the costs that we're getting ourselves into there. So in terms of managing your debt load, it does take a good management plan to pay down the amount that you owe so that you don't no longer have to rely on that bad or that ugly debt later on in the future. But what's important to know is a reasonable amount of debt to carry is going to depend on your own situation. So on this slide, we have a bit of a guideline, but it is just what it is. It's a guideline. Everyone's situation is different, so the amount of debt that you should have or amount of monthly payments is going to depend on that. But just as a little rule of thumb, it's called the 20-10 rule. So the 20 part of that is that your total debt load should not exceed 20% of your yearly income. So basically, if your yearly income was $20,000 a year, then this rule would say that your total debt load, so the total amount of debt that you have out, should be no more than $4,000. So then the 10 component of that rule is that your monthly payments shouldn't exceed 10% of your monthly income. So according to this rule, if your monthly income was $1,666, then the total payment that you're paying every month on your debt shouldn't be more than $166. But the one exception to this rule is a mortgage on your house, because that's the biggest debt probably that you'll ever have. And the affordability rule for housing is a bit different. So this guideline says around 35% of your income should be housing costs, and the mortgage payments aren't included in that 2010 rule. But again, it's just a guideline, and everyone's situation is going to be a bit different. I am just going to show you an online tool quickly. And it can show you just how to pay off debts in the best way. So I'm just going to share my screen there. So this tool here, you can input different debts. So you can have these little tabs here. I just have debt 1, debt 2, debt 3. And basically you put in whatever you owe on that debt, what the interest rate is for that debt, any fees that your bank has for it or your credit union, and then the minimum monthly payment that they have. And you do that for all of them. So I just put in some random numbers. I changed up the interest rate, and then you click calculate. Sorry, first you click how much you could afford to pay each month. So kind of your maximum there. And then after you click calculate, it'll have a result of your total debt load and the amount of time that it's going to take to pay off. And it'll also tell you which debt you should pay off first, which is normally the one with the highest interest rate. And then it gives you just some more information about consolidated loans and a couple of different things on this website. So I'll put that into the chat. And then I'll just go back to the slides there. Okay, so moving on to dealing with creditors. So Lavinia talked a bit about an option for taking control of your financial situation might be to contact your creditors. So you might be able to renegotiate the terms of your debt. Some creditors would be very open to it and some might be a bit more aggressive. It just depends on the creditor, but it is important to have a good communication with them. It's also important to keep a record of any conversation that you have and to get any agreement that you make with them in writing. And it's also important to keep the promises that you end up making with them. So if you find later on maybe that what you agreed to you can't follow through on, contact them again and try to negotiate again. So the best approach before you make these calls is to have a repayment plan to propose to them and try to make sure that it's something that's realistic for your situation and something that you can achieve. And you could ask for lower payments or lower interest rates or a longer time frame maybe within which to pay the full amount. So then lastly is collection agencies. So collection agencies are private companies that your creditor will pay to collect the unpaid debts. So dealing with collection agencies a lot of the time can be pretty stressful. And they might try to use aggressive tactics to get you to pay or something like that. But even if you are in debt, you have rights. And sometimes collection agencies, their tactics can even border on harassment. So what's important is that if you're an informed consumer and you know what the rules are and what your rights are, you can better advocate for yourself in these situations. And the rules for collection agencies do vary by province, but just lastly, I'm going to show you the Ontario government's website that talks a bit more about it. So this section on the website here talks about how to handle collection agency calls and the rules that they have to follow before contacting you. So it gives you just a bit about your rights and a couple other links you can click on, where to file a complaint. It talks about the collection agency's responsibilities, who they're allowed to contact, who they're not allowed to. If you owe money versus whether maybe you didn't owe money and there's an issue, what you can do there. There's more links. It also gives some credit counseling agencies that you can contact if you are in need of some help paying the debt. And yeah, just a couple more links there, different steps to file a complaint. So again, I'll put that link into the chat. And then I'll just open it up if there's any questions on that.
Okay, I think there's no questions. Just looking at the chat now. Okay, Elliot Kelly has added some information on there regarding banks. That's good to know. So if there aren't any other questions, I'm going to thank everybody for participating in our two-part series of financial literacy. And please contact the Durham Community Legal Clinic if there are other financial literacy topics you would like us to present on, if there are materials from today or last session you would like to access, or if you have any further questions. I'm going to also put my email in the chat, and anyone that wants any of this information later can just email me and I will send that out to you. Okay. Thank you. Bye.